What's up, everybody? Welcome to the Stocks channel. My name is Cory, and in tonight's episode, we're doing another stock market technical analysis update, and we're going to start out by looking at the ticker symbol SPY, the SP 500 ETF. But before we get into the charts, you know what you gotta do. Go ahead and smash that like button and subscribe to the channel to follow along on all of my updates. Now let's get right to it and crack open these charts and see what's going on in the stock market today. All right, so we see today that the market closed up on the S&P 500 about 0.3%, which is very nice to see the S&P 500 continue to close above the 5 EMA, which is still a very bullish trend that we have here. Now I did notice with last night's video, there seems to be more and more fear in the comment section and a little bit of a doom and gloom panic story. And I want to remind all of you that panicking is not a stock trading strategy. While yes, it gets emotional when you're near these all-time highs and you're trading around these resistance levels, if you stay objective and you follow the price action and you follow the trends, it's going to give you all the information you need to be a successful trader. So while it's very natural for humans to be emotional, emotion does not make you a good stock trader. And typically speaking, your emotions will make bad trades if you're not being objective on why you're actually making that trade. So right now, looking at our downside risk in this market from today's close, if we assume we would close all of these gaps below us, that's still only about a 3.5% pullback. So getting extremely scared or extremely bearish just because we're at the all-time highs that we were at in February doesn't necessarily mean that the market has to crash just because the majority of the people are thinking it's time for a correction. Now remember, on the S&P 500, we still have this price target up here about $341. And we have not yet hit that price target. Now we can also see here, if we zoom out a little bit, we see here that we do not have any abnormal volume spikes either. Typically during a mass sell-off, we'll see volume spike and we'll get these giant red spikes in volume on down days. Right now, yesterday we did have a slight increase in volume, but it was nothing abnormal and more so just a natural day of red, which is completely healthy for the stock market. The stock market cannot go up in a straight line day after day. There's going to be days where we see these 2 to 3 day sell-offs. And then of course, when we get to our price target, we are expecting to see a sort of ABC correction that could last for a couple of weeks before we continue the uptrend and see some more upside price targets. There's no reason to try to predict when the top will be, because yes, we have a price target of 341, but that's not to say that we can't come up here and go into the 350s before we see this ultimate correction, which would bring our ABC correction down even higher. And depending on where you're trading in this market, you're trying to time something that is not a guarantee. There's no guarantee when the stock market will correct. Will the stock market correct? Yes, of course it will. But we don't know exactly when the stock market will correct, so we remain objective and we remain vigilant at watching the price action and watching the technical trends. So if we go back to the March crash, we see there was a huge volume in selling around the end of February, and that was a warning sign that there was something going on in the market and there was a lot of big money, aka smart money, that wanted to get out. Now you use these opportunities to sell on the bounce. You don't want to sell on the way down, and you can sell on the bounce and you can exit. You always have an opportunity to get out of the stock market. Just like stocks don't go up in a straight line, they don't go down in a straight line either. Now, this could be a good time to start taking some profits and taking money off the table, as we'd had this nice rally and we're now back to old all-time highs. But it doesn't mean just because we're at old all-time highs that you need to sell 100% of your positions and get out of the market because it's coming crashing down. That's just not the case. That's an emotional decision, not an objective one. So right now we know our downside risk is about 3.5%. We saw the price action go up to our all-time high today. So if we go to a 1 hour chart, we can see the price action tried to poke above the all-time high and ultimately got rejected. So we're going to continue to watch that in tomorrow's trading and tomorrow's price action to see if we're going to break back above this all-time high and continue this uptrend. The technicals are still very bullish, and the price action closing above the 5 EMA is going to be bullish no matter how you look at it. So today was a very good day in the market, and it's going to tell us that we still expect to see some more upside momentum before the selling starts. Now remember, with upside momentum is there's no way to know when the momentum's going to end. We have price targets up here that could take us all the way up to about 370. Now right now, I think 341 is the most realistic price target, so we'll get there when the time comes. But if we get to 340 and we still start heading higher, we have our next price target up here right around 353. So there's still plenty of upside to this market. And just because we're at a previous all-time high doesn't mean that the uptrend is going to just stop in its tracks and we're going to see a reversal. That's not how momentum works, and this is definitely a momentum market. So while yes, I understand that there's rising fears in this market, trade objectively and watch the price action and watch the trends. So let's jump over here and check out the Nasdaq 100 QQQ ETF, or the triple Qs. And we see that the triple Qs did hit our price target of about 280 today. So if we go to a 1 hour chart, we see that this candle wick came right up here to our 280 price target before ultimately closing down lower. So still very bullish. We see the price action well above the 5 EMA today, and the Nasdaq 100 closing up about 1.4% today, which is very bullish. Now we did hit our upside price target of 280, so that means we have to go through a correction, right? No, not necessarily. So while it is an increasing risk that we'll see our correction soon, we do still have price targets up here that says we could still go higher. Now the risk increases as we hit our price targets because the upside potential is starting to become more limited and the downside correction is still a very real possibility. So if we look on the Nasdaq 100, before we find support, we could come down about 5.5%, which is a very healthy pullback. If you go back and you zoom out on this bull run that we've had previously, you see days where the market pulled back for about 3 days, and we easily had about 5 to 6% pullbacks before this uptrend continued. There's nothing wrong and there's nothing bad about these healthy pullbacks and these healthy corrections and the upward momentum of a bull market. That is the saying, buy the dip. It's essentially saying in a bull market, you know you have an established uptrend and you're more likely to make money off trading if you're buying those dips and then allowing that trade to recover from the drop or the correction, and you'll make your money back on the way up. So you always want to understand your lower support levels, and down here on the Nasdaq 100 QQQ ETF, we have support down about $264, which is a little more than 5% away from today's close. So keep in mind, you have to manage your trade strategy with an objective strategy, not an emotional one. So we know our price target was hit, so that automatically tells us to become a little more defensive and maybe take some more profits and some money off the table so that we have that capital available in any event that there's a correction or a pullback. We can put that money back to work and make money back on the way up. So if we get a pullback down into the support level, we could add into our position because we took profits up here like a disciplined trader, put our money back to work and make more money back on the way up for the next rally. So keep in mind, that is how a successful trader manages their money. They don't just panic and they don't just completely exit the stock market because somebody told them, hey, by the way, we probably just double topped and you should take your money out of the market. Don't listen to people that tell you to act off of emotion. If somebody's telling you to make a trade, make sure you understand the reason that trade exists and don't just follow your emotional reaction to something that you're seeing or hearing. So still very bullish on the Nasdaq 100. We still have upside price targets that could take us another 4 or 5% higher. However, we do also have about a 5% pullback into support at these levels. Now we also have the 20 simple moving average, which has been doing a great job of holding up as support on the Nasdaq 100, which is about 4% lower. So ultimately we have about 4 to 5% downside before finding support in this market, which is always good to understand your risk and your reward when you're making a trade in the stock market. So jumping over to the Dow Jones Industrial, this is the DIA ETF. We see the Dow Jones held up nicely off its 13 EMA and ultimately closed higher above support, which is the previous breakout of the previous high. The Dow Jones, the Nasdaq 100, and the SP 500 are all still looking very bullish with very bullish price action and very bullish trends. So when all of the indices are aligning and all of the indices are pointing to higher price targets, there's no reason to become bearish. Now remember, the Dow Jones has yet to close its gap from the March crash, which is still about $289 price target, and we're only down here around $278. So we have about a $10 gain to the upside on the Dow Jones, which is still very good potential for upside price targets, and above that, we have Fibonacci extension levels that take us into the 290s. So overall, there's still a lot of money to be made in the stock market and there's still a lot of upside. Now that doesn't mean throw all your money in at the top if you're out of the market right now. And if you're out of the market right now, you have to tell yourself, why are you out of the market right now? Did you panic sell somewhere along this bull run when there was really no reason to completely exit the market? There's always a good reason to leave some amount of money in the stock market because you never truly know where the top is going to be. Now, another interesting thing with the VIX is the VIX has been flashing some warning signs that we need to acknowledge and we need to start paying attention to. We had the VIX close up higher today, even though the stock market went up higher today. Now remember, the VIX is our fear indicator, and we want to see the VIX go lower as the stock market goes higher. And we're starting to see a divergence with fear in the market. We're starting to see fear go higher even though the market's also going higher. Now this could be indicative of what I've been talking about with people panicking at these previous all-time highs and just starting to hedge their position with puts. However, it could also be a sign that there is a growing fear in this market and we're due for a pullback soon, which goes hand in hand with hitting our price targets. As we get to our price targets, we remember that price targets mean we're more likely to see a pullback correction before the upside continues. So right now, pay attention to the VIX and pay attention to this 23.5 level on the VIX, which if we do get a close above that with this reversal in the VIX and the trend starting to reverse to the upside, that would give me an indication and probably an early sign that we're going to start seeing that correction in the stock market. But right now, it's not a complete panic sign in the VIX. It's just an early warning symbol that we have to respect and we have to start paying attention to. So let's jump on over to the financials, and we do see the financials starting to come down, and they did test its previous breakout level, which did not hold up as support. And remember, I was saying watch for the financials to bounce off support before making a trade to the 200 simple moving average. And this is exactly why you wait for that bounce, because as you can see today, we closed well above support, and we see that that support level did not hold up because we never got the confirmation of the bounce. Now this could be a fake out in financials because we also did see the price close below our trend line, and it could just be a little shakeout before the financials ultimately get ready and come back up in here to the 200 simple moving average. And that's just something we'll have to keep an eye on. But right now, as a disciplined trader, we need to acknowledge that there's another support level below, which is right about here, about $1 lower than today's close. So we still do have downside support where we could find a bounce before ultimately coming up and testing this 200 simple moving average. But remember, the financials did break out of a consolidation wedge to the bullish side. So I'm still bullish on the financials as long as they can hold up above this last support level. If we get a break below support, all signs will start changing and we will start seeing some bearish indications in financials, which will not be a good sign. So look for financials to bounce because I still see a lot of bullish price action in the stock market, and I'm still expecting to see financials join in on the fun very soon. Jumping over to industrials, we see something very similar with the breakout and the failure to test the breakout as support and maintain it. However, with the industrials, we do see it finding support right about the 13 EMA, and we still have our bullish upward trend line, which could also act as support. So I'm still expecting to see industrials bounce off of one of these support levels and continue its bullish upward momentum because the price action and the trends are telling us to expect the bull run to continue higher. So right now, I'm expecting financials and industrials to join in on the fun very soon, even though we see technology carrying the SP 500 right now. This gives us more confidence that technology could actually have a sell-off, and financials and industrials could keep the S&P 500 afloat as they regain their strength and continue their bull rallies. If we jump over to the healthcare sector, we see a very similar indication where the support level did not hold up from the previous breakout, but we still do see the price action holding above the 20 simple moving average. And we still do have the 5 EMA trading above the 13 EMA. So this is definitely a sector we want to keep a close eye on, because if we see healthcare start to break down and head below these support levels, we will know that something is going on in the stock market that we need to start paying attention to. But like I said, there's warning signs being flashed, but nothing to panic about because all of these indications and all of these trends are still very bullish. As long as healthcare can hold above its 20 simple moving average, it can find support and continue to head higher, making new all-time highs. Jumping over to the US dollar, the DXY, we see the US dollar close down about 0.25% today. Now with the US dollar, we're not expecting to see any strength anytime soon, and I would expect its downturn trend in the dollar to continue any day now. We did see some time to consolidate this previous drop, and we're really just taking time off the clock before I think we'll see more weakness in the dollar. Remember, more weakness in the dollar means we're going to expect to see asset prices continue to inflate, and that would only go hand in hand with the stock market going higher, forming new all-time highs. So jumping over to Apple, our market mover, we still see Apple had a great day today, closing up over 2% higher. Now, Apple is our market mover, so we do see Apple continuing that bull trend, and as long as we see our market movers continuing their bullish trend, we expect the stock market to continue to grind higher. So we're really not getting bearish, or we're not expecting a correction until we see Apple show some sign of this 5 EMA rolling over and closing underneath the 13 EMA. So there's no reason to call the top. Apple can continue to run, and this market can remain irrational for much longer. There's no reason to try to predict the reversal, and there's no reason to become bearish until the price action and the trends tell us that there's been a reversal. Right now, look for Apple ultimately to find a top and start reversing before we expect to see our correction in the greater broad indices of the stock market. So we did see gold close up a little bit higher today, and we did see silver close up a little bit higher today, which is also no surprise with the weakening dollar. So remember, these asset prices have been continuing to inflate, and we don't expect to see that change anytime soon until we see some sign of a reversal. So going back to the S&P 500, we're still holding up around our previous all-time high, and the bulls are still keeping the price action very bullish right around this range. So look for this upward trend to continue. I do think we're going to see 341 at a very minimum price target on the S&P 500. And remember, on the Nasdaq 100, we've already hit our price target. So it's very possible we see tech start to sell off, and that rotation of that money to head into financials and industrials, which will still carry the S&P 500 to our price target, even if technology has a little bit of a cool off. So that's why it's so important to look at all of the sectors. We still have other sectors that are bullish, and it's not just about technology anymore. Financials and industrials are showing signs of strength, and we're going to see them carry the S&P 500 to these higher price targets that we have here. So remember, everybody, I can't stress it enough. Panicking and fear are not trade strategies. Stay objective, watch the price action, and watch the trends. And you know that I will always be here updating you on your stock market technical analysis. So remember to smash that like button and subscribe to the channel to follow along on all of my future updates. So thanks for watching, everybody, and as always, I will see you all in the next episode.